Thursday, April 4th, 2024. I am with Originator Success here with your daily rate update, the only place on the web where you guys get to join me and talk about what's going on with rates and pricing each and every day. Don't forget to smash that like button, tag an fellow friend, share us in a group. Remember, you can join me live each and every day, 9:30 a.m. Eastern time. If you're watching on the replay, don't forget to click hashtag replay. Let me know that you were here in the comments. Remember, you can sign up and get our written email lock advice to your inbox each and every weekday morning, www.ratelockadvice.com. You can also get our text alerts at www.ratetextalerts.com. They're $7 a month. You should definitely check them out. Last but not least, if you are a mortgage originator, you need to check us out at originatorssuccess.com. Check out our elite membership where we help you to get loans from Google and social media. Find out more at originatorssuccess.com. It's great to have you here. If you're here this morning, say good morning. Let's see who's here. Say hi. Let me hear it from the live folks. Say good morning. We got Mr. Kenny Rivard here. Hello, sir. Yasmin Martin. Good morning, Yasmin. Kyle Mazikas. Great to see you here as well. Who else do we have here this morning? Go ahead and say hello. I've got a bit of a stuffy nose. I'm either fighting allergies or a cold. Either way. Good morning, Crystal. Great to see you here. I'm going to have a sip of coffee. We'll give everyone a moment to hop in. Numbers are a little low yet, and then we'll jump in and take a look at what's going on. So good news today. It's actually a good day. Finally, you're not going to be mad that you're watching today. There we go. Keep the mouth wet here. I know that sounds gross. All right, let's start off early with good stuff here. Let's take a look at the technicals. Mortgage-backed securities are up 11 basis points to start the day. However, not only are we up 11 basis points, take a look down here at the 48-hour chart. We started out yesterday when pricing came out right around here at the lowest point of the day. On this chart, when we see a movement up like this, that's mortgage-backed securities improving on the day. That is fantastic news. There were quite a few reprices better yesterday. And in fact, if we go ahead and let's see if I can zoom in on this, which we can. All right. So on the day before, on Tuesday, we had the same kind of behavior. We were down at the lowest levels, saw mortgage-backed securities come back up, and then we were down on the day yesterday. Saw mortgage-backed securities come back up. Looking over here at the candlesticks, you can see these long tails, this skinny, thin part on the candlestick. That's called a tail. And it's great that we've seen a kind of a line in the sand right here forming as a technical support level. Bonds not wanting to break below that. They've started below it, but they end the day above. Been below it and then end the day above. This is fantastic that we had 2 days that we started out very negative, but actually ended the day improved both Tuesday and Wednesday, bringing mortgage-backed securities, the 5.5 coupon, up to 99.20. Again, we were down to 98.70. That's a 50 basis point swing between these 2 days. So what that does, when we take a look and you see how that looks with when we look at mortgage rates, let me pop this up over here. All right. That means that we saw rates that have pushed up from the high sixes into the 705, 706, 707. These should be dropping back down. We should see that improvement today. Now, again, everything is going to change tomorrow. Tomorrow morning, we have the jobs data, the BLS jobs data. It's coming out at 8:30 a.m. Eastern time. We've talked about this many times. We know that it's going to have a big effect and that, we kind of question some of the readings on it, but it's shown a lot of labor market strength. We've already seen labor market strength this week from both the JOLTS data, job opening labor turnover survey, and from the ADP private payroll, showing a lot of private payroll. So a lot of the strength on that as it is. Tomorrow, though, we're going to be looking at the unemployment number and we're going to be looking at the wage increase. How much have wages gone up? Now, let's look at these technicals here, right? So looking at these fancy candlesticks, last time we had labor data was back here on March 8th, and we actually did improve on the day. Even though we had strong labor market data, we had unemployment go up and wages were not moving. They didn't increase as much as what was expected. However, that next week, we lost a lot of ground, but we had built up and we kind of peaked right here. And that was in March. This time around, we're going into the data after hitting a down spell, the opposite of an increase. I mean, we had gone from right here at 98.58 and we were up to 99.72 as we hit that level. We are way below that level and we have some room to recover if we get data that markets even like remotely. Now, what do I think is going to happen? I think we're going to see the number of jobs created is going to be strong. It'll come in at expectations or maybe a little bit above it. We continue to see labor market strength. Companies are making money. People are out there spending money. I said this every single day, whether they're earning that money or not. Now, there was an interesting article in the Wall Street Journal that that says, what's wrong with the economy? It's you, not the data, right? This was an interesting article from Greg Ip, and it said many Americans believe that the economy and their finances are worse than they really are. Now, it's kind of an ostentatious comment, in my opinion, headline, byline, actually, for that. But he says the Wall Street Journal's latest poll swing states 74%. That's 3 out of 4. Respondents said inflation has moved in the wrong direction in the past year. This assessment, which holds across all 7 states of their swing states that they did this little informal poll, is startling and sobering. He's a journalist, so he's got to use fantastic little adjectives, right? And simply not true. I'm not stating an opinion. This is something on which reasonable people can disagree. Isn't something on which reasonable people can disagree. Well, maybe I'm unreasonable because I disagree. If hard economic data count for anything, we can say unambiguously that inflation has moved in the right direction in the past year. Well, I showed you guys that CPI inflation report, and that's really what he's kind of referencing is when we look at the CPI chart. Yeah, you can argue that inflation is moving lower. And he says, well, that's what people don't realize. But what he's not really taking into effect is people are feeling the crunch that they don't have money. And that's what they're feeling. It's not the truth about the inflation itself. People are feeling the pinch that they don't have cash. That's what happens when you burn through all the money and we're still paying exorbitant prices on a lot of things. And unfortunately, it's not going to change anytime soon. But this was an interesting article that talks about this. And he says, inflation was 3.2 compared to 6% a year earlier, et cetera, et cetera, et cetera. Now, why do I kind of bring this up? Well, because this is what people are feeling, and they're feeling the pinch, but they're still spending the money. And that's what we need to be very aware of, that this is definitely something that's going on. As far as the effect that it's having here on the Fed, the idea of a Fed rate cut in May. Look at this. It was up to 98% that it would stay the same. It's gotten just a little bit better, but we're not going to see a rate cut in May. However, the June, remember, this had gone down to about 55%. Now we're back up to a 60% probability of a rate cut in June. Tomorrow's labor market data going to have a big effect on this. If the data comes in and gives us any kind of chance of improvement, right? If the number of jobs created came in lower, if unemployment creeps higher, remember, it's really unemployment that the Fed is watching. It went from 3.7 to 3.9. If it were to hit 4.0, we would see things improve. If it were to hit 4.1, we would definitely see things improve, because that's what the Fed is looking at right now. They're looking at that unemployment number, and they're watching it. Now, we've had a lot of Fed speakers this week. Yesterday, Fed Powell, I don't know if I should have had this up on Bloomberg for you. Let me make this a little bigger, see if I can find it. But Powell, he basically said that things were on track and that they expected to see some of the strong data that they've seen, and that it doesn't really change anything in their big picture. They're still intending on cutting rates, but they're not committing to when. Ron said maybe that Wall Street Journal author needs to understand math. If inflation was 6% and now 3.2%, that means prices are up a cumulative 9%. That hurts. Yeah, exactly. Right. I had the same thing. Now, he does say specifically, he actually addresses that in here. Let's go to that article and I'll show you. He says, some individuals faced higher inflation, someone who bought a house, for instance, but the average person, inflation went down. He's referencing the inflation. And basically, because people say that inflation has gone up, prices have gone up. And that's what he says. The average person thinks inflation went up. When it comes to the economy, the vibes are at war with the facts. The vibes are winning. And he makes it, again, we're going to see a lot of this. Usually the Wall Street Journal is not left-leaning. It's not like the Washington Post. Bloomberg, also much more left-leaning. But he sounds like he might be a little bit left-leaning. This is obviously bad news for President Biden's re-election hopes. He can't exactly tell voters they're wrong. He'd be called out of touch. It probably wouldn't change anything. The vibes seem symptomatic of a broader pessimism, discontent, disconnected from the data. It's tempting to chalk this up to a misunderstanding. Lower inflation means the level of prices is still rising, just more slowly than before. People sometimes conflate inflation with the level of prices and believe inflation is getting worse. Again, he's kind of splitting hairs. Yes, but the bottom line is consumer sentiment. People are feeling the pinch. They're not happy with what we're spending, and it's hurting, but yet people are still spending it. Again, where's it coming from? It's coming from credit. And as long as we don't see a credit bubble, we're okay. But if we do see a credit bubble, that's going to be bad. If we were to see this credit bubble pop, that is when, and I'm calling it a bubble, and I'm not really saying it is a bubble, but if we were to see this whole credit scenario pop, then we would see everything change. Ron said WSJ's news area is left-leaning. The editorial page is more centrist. I agree. Wall Street Journal is not as bad as Washington Post. Yeah, it's not as much. And again, I don't generally see him lean too hard on it, Ron. So I'm with you on that one. And it's still mainstream media, which is all has a bit of a left lean to it. So, but anyway, bottom line on this, we got a nice day. Mortgage-backed securities are up on the morning, which is fantastic. We're up 12 basis points. Reprice risk on the day is low. It's not likely that we're going to see things that are going to get worse. I don't think we really have to worry about that. But remember, if you're locking anything ahead of tomorrow's labor market data, you need to lock it today before the end of day, or unless you have overnight protection. Because we don't know which way the labor market data is going to go. If it were anything, it's not closing in the next week or two, though. I mean, obviously it's closing in a week. You're locking it anyway. I would float. I would see how it goes. I would take the risk. I don't think it's going to move in our direction much, but we have the potential to really see it improve. Anything that's 15 to 30 plus days out, like we talked about yesterday, absolutely be floating that stuff. There's no reason to lock out of this. Now, take a look. We've seen this 10-year treasury yield fall back to 4.32. This is a big deal in my book. Some people would poo-poo it. I think it's a very big deal. We're at 4.32 right now. Now, arguably, once you pass a support level, and on the 10-year treasury yield, this 4.32 has been a very strong level. Remember, yield, this is going up, which is bad. We want the yield to go down. It's the opposite of this other chart. With mortgage-backed securities, we want the price to go up, but on this, we're marking yield, not price, and we want the yield to go down. It's the opposite. If prices go up, the yield will go down. So, once you pass it, arguably now this is a resistance level, and we would see 4.32 act as resistance. Depending on what happens tomorrow's data, though, is going to be much more important than this technical. If we get data that the market's like, the 10-year will continue to drop back down, and we'll see prices go back to where they were last week for rates. If it were if this labor market data is not looked at favorably, we're going to see the 10-year pop back up to 4.40. It'll go up another 8 basis points, and basically that'll bring rates up a little bit higher than where they were, but not too much. It'll be similar to what we've seen for the worst levels this week. So that's what we're looking at. Ron says, let's see. Ron says, Danielle DiMartino reported yesterday credit defaults are growing. People are running out of money in credit. I would expect them to continue to grow, Ron, but from what I've read, it's nowhere near a level that has anybody shaking up or has markets worried about it. The good news is that all of this debt, there's definitely people like Christine Beckwith, 2020 Vision Success Coach, that are, you've got the conversation about debt consolidation refis are married to these low mortgage rates. It's a difficult conversion conversation to get them to see the big picture, but they've got 30%, 25% credit card debt, and yet they're married to a 3% mortgage rate. What are my thoughts on the bounce off 4.42 resistance the past couple of days? Again, I think that you pointed out that there was a level right around 4.42 the other day. We've been at 4.32 this whole year. I think that as long as tomorrow's data doesn't come in way stronger than expected, that was just a kind of a one-time thing. I think we'll bounce back below 4.32. I think 4.32 is kind of that line in the sand for this year. If we see labor market data come in really strong tomorrow, expectation of a June cut gets pushed off. The idea that the December cuts, again, we've got a clear winner here with 3 cuts again at 35% expectation. to see cut 20. I'm gonna round to fives, 25% that we see 2 cuts, but still 20% that believe that we're gonna see more than 3 cuts, or that the cuts would be more than a quarter point. There's 30% going on that end of it too. I mean, so we're at 60% that believe we're going to see 3 cuts, or that the cuts would be more than 75 basis points. If we see this worsen, of course, but we'll bounce back. So that's kind of my thoughts on that. What do I have for my lock advice? Let me see if I have that up to date here, and I'll put that up here. Yep. So, I don't worry about the bottom piece. I didn't update it, but bottom line, anything that's closing in the next 30 days, I would cautiously float into tomorrow. I want to see what's happening with it. Anything that's 30 plus days, I would continue to float. I'm not worried about it tomorrow. Even if we get a negative reaction, it'll be a knee jerk. Take a look at what's going on this. We see this happen looking at mortgage bonds. You can see it happen here. It goes down, it comes up. I mean, again, we were at March 8th. We were at our best levels, best rates, best pricing for a while. A week later, March 15th, we were down super low. A week later, March 21st, 22nd, we were up again. I mean, so we're seeing week by week, it goes up, it goes down, it goes up. I wouldn't be panicking. Anything's got time, I wouldn't be panicking at all. So, thanks, Lisa, and great to see you. Hope you're enjoying Ohio. Hope you're healing well. So Mike Morano said, get a blended rate calculator, sell the emotional tie to that 3 to 4% interest rate and a 28% credit card rate. Absolutely. And it does a lot with questioning. You got to let people get to their own process on that. This isn't a sales webinar, but when you're having that conversation, don't try to educate them on the numbers. It's an emotional decision. What you have to do is poke the bear and be like, hey, are you feeling a cash flow crunch? Is it feeling like you're just falling deeper in debt? Is that depressing? Start bringing up the emotion to that? How do you feel about all this credit card debt? Does it feel like you'll never be able to get rid of it? Does it feel like it's just piling up? I know that you don't want to let go of a low mortgage rate. It may seem like the opposite thing to do, but think about how much better you'd feel not opening these bills, knowing that it's just stacking on you again and again and again at this very high interest rate. Taking a look at that, how many hundreds of dollars a month are you paying in interest that on these credit cards that are just going to get worse? Do you see any opportunity or any hope that you're going to pay them off anytime soon? If not, why not consider taking the idea that this may make sense to at least give you more cash flow? You can always take that extra money, put it back towards the mortgage, pay it down, which is like paying less interest. That's the kind of thing that I used to always go with. So there you go, my friends. Well, I'm going to wrap it up. Thank you again for joining me. Tomorrow, I will be coming to you probably from the car, leaving for Pittsburgh to go visit the nieces. And if I have problems with the internet, it may not be a great video tomorrow, but I definitely will come to you. I want to take a look and see what happens at the labor market data. It's a big Friday for us. So I will see you tomorrow. Make sure you see me 9:30 a.m. Eastern time. I'll talk to you then. Take care, everybody. Bye-bye.